In this video, traders, we're going to look at using moving averages to gauge the risk of your trade. This is quite a useful tool. Stay tuned. Hey traders and investors, very warm welcome to you. Thanks for tuning in. Okay, so moving averages, great little tool. Several videos on this channel about moving averages, but they have a really extra powerful aspect to them, and that is you can use them as a filter to gauge the risk of your trade. How do we do that? Something I do very frequently, and something that I think people often overlook how useful they are. We'll talk about crossovers, we'll talk about first kind of pullbacks to them, talk about all those kind of stuff for entries, but actually they're very useful for saying, you know what, I might not take it. So let's explain. Ask yourself this question before you take the next trade. How far away from the moving average is price? What do I mean by that? So we have price chugging. We have a moving average, and by the way, it's going to depend on the time frame you're trading. If you're trading on a daily chart, it's going to be different. If you're trading intraday chart, maybe it's going to be a 10 period. But let's say your 10 period, which by the way is quite an aggressive moving average. 10 is quite aggressive. If the price has moved quite a long way from my 10 period SMA, and on day trading perspective, it's on a 5-minute chart, again, could be anything. We need to be a little bit cautious about going long, right? We are quite stretched, and we know that yes, markets do extend further than expected, but as traders, we're just looking for probabilities. The probability is price will come back to the moving average and explode away from the moving average. So if we're buying when this movement away from or distance from the moving average is too high, all we're doing is chasing that thing, right? Because at some point, yes, it could continue, yes, the whole thing could carry on, but ultimately it's a sign of a stretched spring, especially when you're using something like a 10 or using something, if it was a 100 period or 200 period, then fine. You know, on a daily chart, it can go on way more. But when you're using a moving average that's so short, like a 10, a 20, a 5, even a 5, not so much because that's generally pretty close, but 10 or 20 are good examples. When the price is way above it, you need to kind of say to yourself, you know what, do I really want to be going long? I probably do want to be going long because there's a lot of momentum and strength in this thing, right? We've got a trend, it's strong, it's pushed hard, it's aggressive, but I don't want to be chasing it. I want to be at least seeing this contracting slightly. Whether that's a pause from price, if price pauses, the moving average is going to catch up with it. Whether it's a bit of a decline, it's why we talk about one of my favorite strategies, which is that first pullback to the 20 period moving average. You've got a good extension away from the 20 period. The 20 period catches up, price pauses, which is the best one. Moving average catches up and then it explodes off it again. So really, I would suggest, or I do, and I would suggest in your trading plan, entirely up to you, of course, no recommendations and all that kind of stuff, but it's a good way of adding a filter to your trades. If you find that you're chasing stuff, if you find that you are too late to a move, add this. It's a beautiful, easy filter. What you're trading, whatever you're trading US dollar CAD, you're trading Dow, you're trading DAX, whatever it may be, you can say to yourself, if the price is more than X pips, X points away, I don't want to trade it long. I need to wait for it to come back. And you can do that by going through your chart yourself. Spend an hour going through, looking intraday how far away price gets from away from the moving average. If you're the guy who likes to write a bit of code or get someone to do a bit of code, I'm sure it's a trivial piece of code that just can give you that and can spit you out the most likely, the biggest, the smallest, that kind of stuff. Smallest obviously going to be 0, but you get the point. It gives you loads of parameters that you can work off. But what it will do is it will stop you chasing stuff, and it will also make you patient, because the best trades come when this is the biggest and then it pulls back. So it stretches enough momentum, pulls back, compresses the spring, and then goes again. So actually it can be a precursor for a secondary explosive move, especially if that was an initial drive, moving way away from the moving average. They're kind of spreading off because that's going to the stratosphere. Moving average starting to catch up with it. You don't want to get involved in it until that shrinks slightly, because it's just that supply demand. I'll go back to that point again. Supply demand, massive demand. It's just the easing of it slightly before it's at full tilt again. Can it carry on? Of course, it can carry on, but it just adds and puts the odds back in your favor and stops you chasing stuff a little bit too much, guys. So Good one, good filter. Ask yourself that question, even if you don't want to put it into your trading plan, but if you're trading, how far away from the moving average is price? Should I be taking that into account in my trading decisions? If you just take 2 seconds to think about that before you pull the trigger, it hopefully will stop you chasing stuff a little bit too much. Are you going to miss occasional one? Of course you are, but over time, that is probably going to do you better. It's going to do better for your trading account than not. All right, guys, thumbs up, that kind of stuff. Comments in the comment section below. See you in the next one. Take care. Bye-bye.